Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, July 11th, and we'll see how things look for Monday, July 14th. Going over what happened in Friday's session, the session started on a shaky note, driven by trade-related news that sent the futures lower well before the open. Reports of a 35% tariff on Canadian imports and a potential 15 to 20% tariffs on most trading partners, including the European Union, weighed heavily on global markets. Europe closed in negative territory and the U.S. futures followed suit, leading to a gap down open below the S1 pivot point at 62.58. Despite the bearish start, the market showed resilience. The intraday low was set just below 62.40, and there was a choppy session after that with below average volume, typical for summer months. By the close, the S&P 500 managed to recover slightly, finishing just above S1, down a modest 0.33%. The lack of follow-through weakness suggests buyers are still stepping in to support dips, reflecting persistent market optimism. Looking at market sentiment and the technicals, market sentiment remains at an elevated level, registering a reading of 75, which raises concerns about overbought conditions. Several technical indicators, including the Williams %R, stochastics, and balance of power, are showing extreme positive readings. However, short-term indicators, including the StochRSI and CCI 14 as well as 20, are starting to signal slight weakness, hinting at potential fatigue. Despite this, the market remains well above its 20-period moving average and is positive on all time frames. Growth stocks slightly outperform value stocks, particularly with the large caps, while semiconductors and mega-cap names such as Nvidia and Microsoft held up well. Other sectors, however, showed pockets of weakness, with the small caps dropping over 1%. One area to keep an eye on is the 10-year Treasury yield, which climbed to 4.42%, approaching the critical 4.5% level that previously pressured stocks. The U.S. dollar also saw a slight bounce, though it remains in a longer-term downtrend. These intermarket dynamics are critical, as stocks don't operate in a vacuum. On the economic front, there was a surprise from the Treasury budget, which reported a $27 billion surplus, far better than the expected $250 billion increase in the deficit. While this is a positive development, long-term debt concerns do persist, especially with rising interest payments and new fiscal proposals on the horizon. Trade news dominated the headlines, with Canada and the EU facing tariff threats as major U.S. trading partners. Unlike smaller trade deals, these developments carry significant economic weight, and the market's reaction, or lack thereof, suggests investors are still treating the news as mostly positive. This exuberance, while supporting the short term, could signal a shift if sentiment turns pessimistic. Looking at seasonality, a key factor to this time of year. Historically, the first half of July is one of the strongest periods for the market, and we're seeing that play out with positive trends across the Dow, S&P, and NASDAQ. However, the second half of July tends to underperform, and we've seen notable mid-July pullbacks in 2023 and 2024. In 2023, the market declined into October after peaking in mid-July. In 2024, we saw a near 10% correction after setting all-time highs. While this is not predicting a repeat, these patterns remind us that the market doesn't like to be taken for granted. The upcoming week will have options expiration, historically up 57% of the time going back to 1980. Looking ahead to Monday, July 14th, the market will likely trade without major economic catalysts as no significant reports are scheduled to be released. Earnings season will kick off later in the week with major banks reporting, which could set the tone for broader market sentiment. Geopolitical developments, such as tensions involving Israel, Iran, Russia, or Ukraine, could also influence price action, though they've had minimal impact recently. Technically, the market remains positive but shows signs of exhaustion. The S&P McClellan Oscillator and Bullish Percent Index has turned negative, and the NASDAQ 100 continues to approach a long-term key trend line. In conclusion, the market remains in a positive trend across all time frames, but overbought conditions and historical patterns urge caution. Tariff news and rising yields are potential headwinds, and the shift from extreme optimism to a more balanced sentiment environment will be key to monitor. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.